Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
We're back at it. Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop, founder, managing director, chief toilet cleaner over at Pure Property. Paul, how are you going?
I'm good, Philip. Toilets are clean and the economy is not humming. We'll continue on.
Wow.
Extra good riff.
So the economy's not humming. Well, we saw today, and this might timestamp this podcast, but looks like there's going to be some trade wars going on. Heavy tariffs.
Yes.
Australian beef, just as I was walking.
Yes.
Lots of steak. Lots of steak. Australian beef. Copping a 10% tariff. I saw I collared it when I was just walking into the studio.
$3 billion in meat that the Yanks buy from us per year.
Yeah.
I found that to be a very large number. Is this a fact check opportunity with Trump, or is this accurate, do you think?
I don't know, man. I'm not
Seems
a beef
like
expert.
a lot of beef. I'm no expert.
I know I'm an expert in most things, but
export Wagyu, grade 5.
Well, I know some in certain restaurants in New York. Some of my favourite New York steakhouses. Australian beef's well regarded. Like it's a prestige item on the menu. People go,
not much
like,
longer.
You know, I want Aussie beef. It's well regarded. You know, people think it probably hasn't got all the hormones that American beef has.
Yeah,
they got big animals out there, right?
Do.
You know,
extra large.
Texas. Yeah, they're like a big steer horns.
Big
but,
steer, stag.
Staghorn. But I heard some of his commentary on, and he's like, you know, people in Australia, they make good beef, but mate, why are we buying your beef? You know, we want people to buy our own beef.
Yeah.
They slug a 10% tariff on it. It'll stop people buying it.
I think we got out of that lightly, to be honest with you. I think from what I could see from the pundits across the board, there was probably expectation it was going to be a little bit more, but we're such early days here to see how this plays out.
And a lot of it is just Trump being Trump, right? This is how he does deals, right? He'll put it all in there and then take it away.
Yeah.
And he's seen to be
waiting for people to kowtow a couple of days later.
He'll get what he wants, and there'll be some underlying real purpose behind his negotiation, and he's obviously wants to stimulate the American economy. A lot of people think he's actually deliberately doing this to put a shock into the economy, put into a recession, shake things up, come out of it, and
start again.
Happy days, right? But look, I get, you know, it's a very difficult situation in that sort of post-World War I, World War II is this idea of globalisation, and we should be a global economy. Then everyone who does the different stuff buys and sells stuff from each other. There's always a deficit or a surplus. It doesn't always balance out, right? Yeah, so some people benefit from trade, some people negative, right? But Australia, we need to buy a lot of stuff in here.
Yeah.
We sell a lot of stuff out, but it's normally stuff we dig out of the ground, and we buy a lot of stuff in. So, yeah, there's surpluses and stuff. But the reality is that post-World War II, when there was this sort of holistic sentiment, is that we need to work closer together as nations, and trade being one of them, and a globalised economy works for a period of time. But there gets to a point where people start going, well, this bit fractured. It's not working quite well. And Europe in particular, you see how that is quite fractured. The UK left the European Union and Brexit because they went, this ain't working out. It feels as though we're giving more than what we're getting. And nations are always going to protect themselves and their own sovereignty, and they're going to make the decisions they want. So we're at that period of time now where, you know, it's not all kumbaya. Nations are going to put up their barriers and borders. They're not walls anymore. They're trade barriers.
Yeah, and mate, I think the outcome of everything is still certainly a long way from being known, and the share market's showing that as well, both in Australia and overseas.
I looked at I'm sick of it. I thought it was a genius about sort of
you and me both
2 or 3 months ago. I was going, finally,
can't lose.
Finally,
buy more, buy.
And I was, and then I was like, why
that
did
was
I just
the time to sell.
Why didn't I just put it? Why didn't I just? I got a commercial property. I'm negotiating a new rent on it, right? And just lifting that up, like just.
Yeah.
You know, this is a beautiful thing, right? It just changes your cap rate, and you sort of create another $250,000 in value that you can just extract and use it.
Yeah, and it's real money. It's tangible. You're still delivering a product to a tenant who's not going anywhere, and if they fail and fall over or leave, there is many others who are going to take their place.
Yeah.
You're not dealing with the uncertainty of what every time you're opening up that app in the morning, what's going to happen today, what tariff's going to come out of this tomorrow.
You can't control it.
You just can't.
You just can't control it. And it's one of those key things as property investors, you know, is you got to control it. You got to concentrate on things you can control, because there's a lot you can't control, and this sort of stuff you simply just can't control it.
No.
You just got to just get on with it, right?
Yeah.
But it comes back to the point, that being a key thing of what you should be focusing on. Concentrate on the process, and the outcome will set itself up, right?
Yeah.
Like that's the key thing around it, without getting too blinkered with what else is going around there. And importantly, with property investment, and I sort of fall into this trap. I don't know if you do. Not what we're chatting about today is that, this point of concentrating on the process, the outcome will sort itself out. Very structural, makes sense. Concentrate on those things you can control. Don't worry about those things you can't control. These are good ways to sort of build a framework for investing. But importantly, also, you've got to have fun with it. If it's not fun, it changes your mindset. It realigns or adjusts your thinking. You might make wrong decisions as a result of it. You've got to try and make property investment fun, and sometimes it doesn't feel it.
How would you do that, Philip? Because I do it a lot, and I've done
How to make it fun. But I find it quite fatiguing, right? So then it's a real perceptional attitude adjustment where you got to go, Phil, mate, why do you have a negative perception about this today? And I sort of, I did it this morning.
Yeah.
So why have you got a negative perception around property investment today? Like, are you sitting there going, it's all a nuisance, it's hard work, you don't like it, you don't want to be doing it, you just, you'd rather not be doing it, all this sort of stuff, right? And I go, how do I realign or readjust that? So I go, isn't property investment fun? It's like useful belief, right? You know?
Yeah.
And you've got to do it. I still do it. Not daily with property, but I do it quite often where I just go, I look at all the negatives with it.
Well, I look at property really fundamentally in the sense that I invest in property to make money over a period of time.
Yeah.
And in the thousands of deals that we've done over the decade, more than a decade now, there has been still no one who hasn't invested for an outcome that is monetary. Yeah. So how do you turn that into something that gets you motivated and a bit of enjoyment? Well, it's not the share market. You don't open up your app or your NetBank app that you have your mortgage attached to, which might actually be able to provide you an up-to-date live feed as to the value of it. You don't look at that every day and all of a sudden see that number change in the green or in the red or in the whatever it might be. What we try to do, and if I'm honest with you, this is probably where we might gamify property from an internal, with a long-term hold or a long-term mindset still in play, is we try to provide annual updates. Because for me, working through all the different timeframes, annually is probably the best time to review the performance of a property, both from cash flow, from expenses, and then from value. So what we try to do, and what we always do on an annualized basis, is reach out to our clients and say, well, you bought 14 Jones Street in Rothwell in 2021. We paid $416,000 for that property then. In 2025, that property now has a valuation of $786,000. That's now an XYZ capital gain. Do you realize that, with that very meager start, here's where you are? What that does is it gives you a purpose, and it also gives you the ability to understand why you're doing it. Because what will invariably happen every time we do those annual reviews, it's a point in time. We send an email. We usually have a meeting face-to-face or over the phone or a video call with a client. That's probably half an hour to an hour, maybe an hour and a half's worth of time. And then every other moment between that and the next 365 days is just going through the motions and in the trenches. And most of that time is going to be a handful of phone calls about something needs to be repaired, tenant might move out, you've got someone who might be late in their rent, and other things that happen in the meantime. That's not necessarily going to be enjoyable or fun. But if you can have your ability to figure out your why and look at that and think, this has a purpose and it's given me a good outcome, that should motivate most people to be able to do it. But you need to make sure that you sort of don't expect that enjoyable and that gratification piece happens, and don't expect it to happen daily or weekly or monthly. It's typically annually, maybe tied into how your buyer's agent works with you, or when you do your taxes with your accountant annually. They're probably your two main ways, or when you speak to your broker to maybe look at your finances and how to structure it the best way ongoing.
So you've got to get excited about your property portfolio. This is what I try and do. And then I'm selling a couple of properties now in that smart property investment portfolio. And these are probably properties we've refinanced. They're out in the western suburbs of Sydney.
Refinanced
probably
more than once.
More than once, at least twice, right? Maybe 3 times.
Yep.
And I'm selling, it's like an apartment in the western suburbs of Sydney, selling for like $400,000, whatever.
Yep. Which you probably paid $160,000, $180,000.
Something like that, right? And it's going to sound sort of again, I've got to be conscious. I've got to put things into perspective,
Very
right?
elitist.
But I sit there and just go, like, we're selling it, and it might realise 120 grand in once the debt's paid off, 120 grand in.
And that's after topping up the loan, obviously.
Yeah. And I sit there and I just go, oh yeah. Like I just sit there and go, okay, like
another meal at Kingsley's.
Well, beef's got to be cheaper in Australia now.
Here
we go.
Wagyu on the menu.
Wagyu on the
at the local
Rissole. Newsflash, you'll be able to get $10 steaks again, right? but put it in perspective, and then I go, oh, that's nice, like 100 grand. Then I got a bill from a woe is me.
You've got big problems.
From an apartment block that we own up in Brisbane for a new roof for 120 grand, right?
Oh, very good.
120 grand.
I go, look at that. One hand washes the other.
And I just go, and I just sit there, and this is the perspective thing, right? I sit there and just go,
what does it all mean, Basil?
I'm just not excited about it.
Yeah.
Every now and then you need a good win. I feel like I haven't had a good win for a while,
right?
And it's maybe negatively shaping my perception. I went to a function over this week. And there were some smart people doing economic updates and stuff, and you listen to it and you just go, mate, property market. And this comes back to your point, going, the economy is pretty sort of lackluster. You just go, mate, the property economy is pretty stuffed, generally stuffed at the moment. And I sit there, and again, perspective, why would anyone invest in property today? Because every step of the way, there's someone with their hand out waiting to get paid, right? And you think about paying stamp duty or land tax, Why is it? I'll put this to you, and I'd like your view on it, right? As someone, you as well, and probably all of our listeners as well, who contribute more than most to the state revenue coffers wherever you live, and I pay
federal,
but so I pay all the company taxes, and we hire a lot of people, and therefore we're great contributors to the national economy, which I don't have as much of a problem with about, right? But I'm talking about state government.
Okay.
Here we go, state government taxes, right? And I want someone to explain this to me. Payroll tax, stamp duty, and land tax, right? Stamp duty generates, I think, about half, I'm generalising, about 50% of the state government's coffers, right?
Yep.
Land tax and payroll tax pretty much supplement the rest. And then you've also got all your local government stuff like the rates and all this sort of thing, right?
Cetera,
Why is it that the people who contribute the most, i.e. people who transact in property and property investors who typically own a lot of property and probably pay most of the land tax, why are they treated the worst? You're treated like a criminal sometimes by the state governments because they'll chase you to the end of the earth aggressively for a land tax bill or a stamp duty's got to get paid at the point of transaction. So you contribute the most, but you're treated the worst. And you have very little say about how they actually spend the money, right? And I just said, and I scratched my head and I'm going, you just keep taking and just pulling as much as you can out of the property economy for whatever the investment decisions you're making. And I don't mind government spending money. I think it's a good idea. But you can only take so much before property investors go, mate, I'm done. This is it. No grounds evictions coming into Sydney, into New South Wales. All these little bits, just layering. I spoke to someone, you know him quite well, CEO of a property company, and he went, Phil, mate, I'm not investing in resi property. He goes, I can't make it make sense anymore. It's just getting hit everywhere you go. Like you feel like you never get you just feel like you never get a win. I don't know. Be careful, state governments. Be very, very careful.
Philip Tarrant is on the loose. He's loaded. Holsters are loaded, ready to fire. Look, Phil, I have a view on what you've probably said there. And look, you're not a dumb person as much as you like to play dumb. You would always understand that, obviously, the voter cohorts are what's going to dictate the decisions of the day.
Yeah.
And unfortunately or fortunately, the way we need to look at it is whether you're buying an owner-occupier or an investor, you still make up the minority of the general public in any state in Australia. Now, it's about a third, right? A third people own their property outright, a third have a mortgage, a third are renting.
Yep.
Now, what that means is that if you're probably that middle third, and let's call it, there's about a third of those people who are renting, obviously means that 30% of properties are owned by property investors. Property investors don't make up the majority of the cohort. So when you think about that, when I think about that, I look at it and say, well, the majority of people who sit there on the sidelines are never going to have an empathetic ear to lean on when it comes down to taxing the property investor, because the perception that property investors are contributors to society isn't there. Basically, the perception is that they are the ones who are doing it for themselves, which they are, but the reality is they're doing it for themselves so they don't have to rely on an age pension at age 65, 67, what will probably be 75 or 80 in the next 20 years.
Back to my point, though, those people who are doing that, they're after superannuation. They're always trying to change the rules governing like unrealised, getting taxed on unrealised gains in your superannuation. Go, oh, there we go. They've got more people probably. Let's tax them. Like
tax them.
Every
They've got a bigger balance. Tax that.
The one thing that probably sustains a lot of this, and I was chatting with a demographer the other day, and I think I'm going to remember this stat correctly. Yep. I think less than 26 or maybe 23, call it 25%. 25% of the voting population live in rental accommodation.
Yep.
So 75% of the voting cohort are either what you just spoke about. There's three aspects of it. They own their own home outright with no debt. They own their own home with a mortgage on it, and or they also a property investor, and that might be, all of those three. Right. So 75% of Australians who vote, and we'll get up to this because we're going to talk about the news. Have some exposure to residential real estate. And as a result of that, the federal government will always be very, very careful, whoever it is, and we saw it happen in 2 elections ago where they tried to tinker with this, the federal government will never, ever do too much to jeopardise the value of Australia's real estate.
Correct.
Because they know if they mess with that and people feel poorer, that's when they're going to have problems on their hands. So that's good news for property investors.
It's good news for property owners, full stop. Because I mean, to be honest with you, the property investors actually don't make up the majority of the wealth that's held. It's the property owners who own their owner occupier who eventually have it with no debt. That's where the majority of everyone's wealth is held, and they are the cohort that no one wants to mess with, because they're like, you mess with the value of my home, you are messing with my retirement.
Yeah, absolutely.
That's where it's always going to go.
But therein lies some of the challenges we have with the housing situation, because now put that down at a level. So that's at a state, at a federal level. Don't mess with it, right? Don't mess with people's wealth at a state level. The state governments, whether it's wherever you are in Australia, they need property to transact in order to make money, right? It's critical. So you hear on one side around housing affordability or affordability crisis or all this sort of stuff, right? Those people who own their big homes with no debt on it, they don't want to necessarily sell it, because if they sell it, they need to buy something new, and therefore they're going to have to pay stamp duty as a result of that. If they don't sell that property, that means someone else isn't buying it and therefore paying stamp duty, right? So these people who have these large family homes, owner occupiers, they're saying, your kids are grown up, they've moved home, you live in a 6-bedroom home somewhere, you really should make that available for another family to raise their kids in and move to something smaller. They go, I don't want to pay all these government taxes as a result of it. If they said to these people, you can transition, you can sell here's a policy idea for someone. You can sell that home and move into a downsized home and not pay stamp duty. They'd sell them every day of the week, and
you could have if you could then open up the opportunity for them to, because most of them are going to be either in retirement age or moving forward. There is a policy around how they can actually funnel some of that cash into their superannuation, but it's capped. Right? Like, and this is the problem. The caps are there. And then when you exceed a certain amount, then you get taxed in your super as well. So they're thinking policies, but they are always thinking about, okay, we'll give them this policy, but you know what? We'll back end a bit of tax after they do it again as well. But they're always thinking about taking a little bit every
But you want to fix things? Okay, let's call them old Australians that own their property. All right, here's a great policy idea for someone out there. Let them sell their property and buy a new property, and don't charge them stamp duty, right? They'll do that because they're probably sick of it. It's big, it's old, needs maintenance. They're too old. There's stairs. There's all this sort of stuff. You do that, they might sell this home over here for $2 million. They might buy this new home over here for $1 million. They got $1 million in cash, tax free, right? That money, then all those children who need help getting into the market, you've just freed up $1 million equity, tax-free, for them to gift to their children so they can buy properties and pay stamp duty on it.
Yeah,
like if you want to
absolutely.
stimulate the Australian economy and fix a lot of these problems, think of that for a policy idea.
The problem is, and this is for me always going to be the problem that we have, is that none of it's instantaneous, right? It's all outside of voting cycles and election cycles. And I think the biggest problem with like that policy would make complete sense in my opinion, but you still are playing the long game, because if you're a 70-year-old who's just downsized and you've got $1 million that you might go and distribute to your 3 children as an example, they might not be ready to buy today. They might still be thinking, okay, great, thank you for my $250,000 deposit in that example as just as a rough number. But they might say, you know what, we probably need to get our incomes up, or something else might need to happen before we can actually borrow money and buy that family home. That might be 2 years, 3 years, 5 years down the track, and it's outside of another election cycle, so on and so forth. And what that never does is move the needle for the...
And we need to move the needle faster, and that's the biggest issue we have
That's what they're
right
always
now.
looking at, is how do I, like a fuel excise tax for 6 months, 12 months, like it's always designed to be how do we appeal to people to win this election.
Yeah,
That's
buying
all
votes.
that's all it's about. And unfortunately, Phil, I don't think we're going to fix that.
No,
we can muse over it to the cows.
But what I would say to the federal government, state governments, actually get people sitting on panels and committees and all this sort of stuff who might not necessarily be academics or might not be public servants, lifetime public service who see the world a particular way. Get people in there who actually sort of duck and dive around property markets, can think a bit pragmatically, creatively around this, because just that one idea alone, I'm sure they can send to the Treasury to model up and go whatever, right?
Yeah.
You would be stimulating property transaction. Now, people will go, oh, you can't do that because it's going to drive up property prices.
Well,
And it'd make it even less affordable for people to get in there. But what you're doing is you're stimulating market demand. There's going to be more money washing around. Why should you have to pay a tax, right? They say if you sell your principal place of residence, it's tax-free, right? You've got to live somewhere. So you're paying a tax at the stamp duty side of things. Fix it, because things need fixing, Paul.
They do.
It's going to take us to what's making headlines. What's the property news right now? We've got a jingle. We've actually got a jingle. I'm going to play it right now. Everyone listen to it. Ready? There it is. Bam.
What's making property news?
And we're back. We spent millions on that property jingle. We
my
like
budget,
it. We like
Paul.
it. But, we were sort of, what's making property news. And we kicked this off last time we were on air and we got a really good feedback on it. We're sort of pulling it apart. I know I probably jumped the gun a little bit because we're talking about the, what's happening within the government's federal elections coming up on the 3rd of May. There'll be lots for us to talk about it. But what I wanted to kick off today, Paul, with this is just data's just been handed down from the March print of data out of CoreLogic. Australian residential property has now reached a new record high valuation, which dipped, I think, a couple of months in a row. I would expect Australian property to always, in the balance, be going up.
Well, yeah, that's what we're conditioned to expect,
Yeah,
right?
yeah.
And on an aggregate, it did see that continued increase, which it has done so for, in the long term, has continued to do so since data began. But it did have a couple of months of dipping. The rate cut probably has had its immediate effect, and that saw some increases pretty much across the board for the month of March. Yeah.
So you're happy? What's any outperformers? Steady as she goes.
There's certainly areas which the big three that have been the big three for the last 3 years, which is the Brisbane, Adelaide's, Perth's, are still continuing on their growth trajectory. Perth's going to be the number one performing market again in 2025 by the looks of the data. I mean, I'm pleased to say that we put that in our Fast 50 report for the last 2 years in a row. Pretty much most of the markets. I mean, I'll just reiterate. Last year we picked the top 9 suburbs out of over 10,000 suburbs in Australia from a sheer performance perspective.
I actually have in my inbox right now the draft report that
The
just needs me to have a
2026
look at it and
50.
say that looks okay.
Yeah.
So that's just about to come out.
You're bringing out your big rubber stamp.
I don't know. I'm a bit nervous about it. They like me to look at stuff because they for
think
some reason they
you're
think
gonna
I actually
veto
know
that.
what's going on. But I've got to give it a sense check, right?
Yeah, absolutely.
Got to give it a sense
and look,
check.
mate, we look at this stuff all day, every day. And Perth, as I was saying, has been an excellent performer. Brisbane's been an excellent performer. Adelaide's been an excellent performer. I'm very pleased to say that we've bought, well, not hundreds now, thousands of properties in each one of those 3 markets over the last 4, 5, 6 years. But the baton will be handed over at some stage, and it probably won't be too far down the track. There's signs as far as markets, which you mentioned. Is there anything there? We did mention Melbourne last month that it saw It was leading the charge. It wasn't necessarily by a long way, but it's shown it's now its third continuous month of growth at 0.5%. It's only really second to markets such as Adelaide had a 0.8%, Darwin had a bit of an outlier month of 1%, but Melbourne's been very consistent the last 3 months and starting to probably show a trend now, which previously I'd probably say it was, you can't rely too much on monthly fluctuations, but Melbourne looked cheap for a long period of time. That didn't mean it was great to buy, just because it's cheap, but signs are now pointing towards, hey, we are seeing probably some better value and also some good green shoots, which previously was, at a point where if you bought, you would know you were buying cheap, but that doesn't mean you're going to see instantaneous results. Maybe looking a little bit less that way, more towards, hey, it's starting to push towards a growth market now as opposed to a balanced market.
Okay, so you haven't missed out on Melbourne yet?
Certainly not. Certainly not. A long way from missing out.
What do the protractors say? They go, "No, Melbourne, no."
This time last year, Phil, 100%. People would be like, "It's cooked. Don't touch it." There's taxes. There's uncertainty in government. There's big debts. They couldn't sort out the com games. There was all this stuff. And it was, to be honest, like this time last year,
litany of errors.
It was just, and it was historical stuff from just really just fumbling on policy, but it is now sitting as to where it's always sat, which is a relatively stable economy with a stable jobs market, with a growing population, with a predicted now state population that's going to be bigger than, or city population rather, it's going to be bigger than Sydney in the next probably 5 to 7 years. It's going to be our biggest city. Whether we like it or not, it does attract probably more of the talent from overseas and also will be interstate from a jobs perspective. That feeds into the economy. It feeds into demand and ultimately it feeds into property prices. But as it stands right now, Melbourne is the second cheapest capital city in Australia.
It's crazy, isn't it?
Second cheapest capital city in Australia.
It's mad. It's mad. And it comes a lot down to property market dynamics, the property economy, call it what it is, which involves real estate itself, but it's also the construction of real estate, so all your trades and all this sort of stuff. There's something not right about Melbourne where it sits right now. So you don't need to be an idiot to work out something needs to change. Now, this is the long tail of COVID. It's a structural thing.
Sentiment.
But sentiment. Back to my original point, though, so many people say to me, going, why would you go to Melbourne now you're going to get hammered on land tax?
Yeah.
Like, it's the first thing they say. And this is, again, just layering more and more taxes on property investors in order to sustain or contribute to the government coffers. Gets to a point where people are just going,
it minimises transactions.
There's a reason for it. So you've got to be a bit contrarian in your investment appetite. Whether they're going to unwind a lot of these things, if you get a change in government down there, which, who knows? You had a change in government in Queensland, shifting parties. So there's a lot of people who are fatigued with the government in Melbourne, and they'll have a chance to vote on this. But
agreed. And I think once this Fast 50 report comes out, we'll talk more about this, and I think that'll be in the next month or so. We'll dive fair bit deeper, not just into Melbourne, but into a number of the other markets where you'll see some featuring suburbs in which we see opportunities, and people will have a chance to download that report very, very soon. So keep your eyes out.
I'd say a week or so from you tuning into this.
So that's
Easter reading.
Yeah, I don't want to be too in depth on the data there because we're going to dig very deep into it. But I personally buying in that market. I know we're buying plenty as a company in that market, but that doesn't mean we're only buying in that market. There are certainly opportunities elsewhere and plenty of upside in certain markets. And even in the what's making news, we talked about Sydney and the transport orientated development scheme changes to the policy of planning that came out only last month. That has affected, in the last 4 weeks since we recorded that podcast, I can tell you firsthand, Phil, that I own a property, and I did own a property before that policy came out, which had probably a market value, I would say, of about $4.1, $4.2 million prior to that policy coming out. I've had an offer since that came out of over $6 million on that same property.
Crazy.
That is purely at a stroke of a pen because the density changed. Now, I guess the reason why I highlight that is Sydney's not a market that I would necessarily suggest is going to see huge upside in the next 1, 2 or 3 years. But there is still opportunity in markets which aren't necessarily growing if you know what to look for.
And this is the point, right? Like, yeah, that might
Experience.
make sense. Someone needs to buy. The developer needs to buy and need to sit on. Developers aren't developing at the moment. 'Cause
Well,
it
but
just
some
doesn't
are. I mean,
make-
that was an active developer who put that in there. But they still can make the numbers work, right? Like, just because it's expensive doesn't mean it doesn't make sense for a developer who has the ability to make margins and has economies. Like, there is ways for. It's not a coincidence that there's still no shortage of cranes in the sky across the Sydney landscape. They're there, and they're not. Not everyone's going broke.
Well,
by the way.
go and count how many cranes are in the sky in Melbourne.
Oh, absolutely.
Right now, I think you might see. I was down there the other week, maybe 5 or 6.
Yeah.
You know,
And comparatively to the last 2 decades, it was a different landscape there.
yeah.
And I don't mind the look of that personally, because when I see cranes in the sky, like you look at something like the Gold Coast Surfers Paradise landscape, that makes me nervous personally. You're talking infinite high-end, high-rise developments. And for me, that never ends well.
And we sort of spoke about this very quickly off air, and it sort of lends itself into the next discussion we're going to have in terms of what's sort of making property news is you speak about these numbers. I think nationally 0.4% was the growth over
About 0.5%, give or
March.
take, yep.
Combined regional 0.5, combined capital 0.4, only one capital in the negative, which was Hobart 0.4%. Darwin 1% was the performer.
Last month was not the case,
yeah.
and they're the markets which they're going to see anomalies.
Yeah, Adelaide 0.8, Brisbane 0.4, Melbourne 0.5, Sydney 0.3.
Growth across the board,
Growth. But from what I understand, though, the affordable markets are dominating, or probably being the greatest contributor to the increasing capital growth across all those capitals. Not just last month, but over the last 12 months.
Over the last 12 months. And to be honest, we've got 12-month data here of what happened over the last year, but you could extrapolate this over the last 3 years, and that graph is more or less the same. And as opposed to us rattling through 70, 80-odd suburbs, what we got access to is a hedonic home value index from CoreLogic, which breaks down their SA3s, which is essentially the largest local government areas. It's an encapsulation of an accumulation of suburbs within the same postcode. So typically areas which have got the same postcode, multiple different suburbs, so larger.
What would be an SA3? So could I say, like a postcode that might have multiple suburbs?
Yeah, correct.
Like 2147 would be Seven Hills, Layla Park, Borkham
exactly,
Hills.
that's an SA3.
Yeah, that's an SA3. Okay,
correct.
Yeah, okay,
so if you look at that as an example, anyone can probably compute that with where they live, and they'll know whether they live in those types, and then it sort of drops down to slightly smaller.
Like Mount Druitt would have Wayland, Tregear,
exactly,
places like that.
Yeah,
okay.
100%. And when we look at all those SA3s in every single major city in Australia, we've found that they're almost entirely dominated by the bottom 25 percentile
bottom quartile
value market, bottom quartile. So if you think of the entire market is made up of 11 odd million properties, then all of a sudden now we've got somewhere around about that bottom 2.5 million properties of value. That is where the majority of growth has been.
So that's where the capital growth actually is, at the bottom quartile.
As a raw percentage.
Yeah,
that's where it's been. Not as dollar value, because obviously it doesn't compute to dollar value. But if you bought $1 million worth of 3 properties in a lower market, you're going to get bigger bang for your buck.
100%. And that's good news for property investors, because, inverted commas, most property investors will either start there or that's the area where they're going to operate, because that's pretty much all they can afford.
That's
now,
what they can afford.
Talking about affordability again, and this is where we're running up to a federal election. Everyone's talking about how the affordability, cost of living crisis, affordability, and all that sort of stuff. Back to my point around selling that property out in the western suburbs of Sydney. It's a flat, right? 2-bedroom flat with a
drive-through garage.
It's got a garage that you can actually walk into the apartment from.
Okay, is it internal?
Probably sell for about $380, maybe $380,000, right? And before we come on air, you said that there's lots of buying activity, and I think you said you're buying in, I'm not going to say where, but in Victoria. And I went, how much you got to get into to get it? You went, you need 60, 70 grand.
Yeah.
And you went, and I went, what? Yeah, you're buying the high 300s, right?
Yeah.
And I sit there going, everyone bemoans that you can't afford property in Australian real estate. Like, you can live in the capital city.
Yep.
In the capital city of the biggest city in Australia, Sydney, for less than $400,000, you can buy a home and
contact Phil Tarrant today.
But there's places like, you go to Belmore, you go all over the joint, right?
They're everywhere. They are everywhere.
So this is the misconception that people
These
think.
aren't studio apartments. You know,
They're
these
two-bedroom apartments with
You
a
could raise
flushing toilet.
You could
Yeah.
raise a family and
Yeah.
no problems at all. If you don't like the colour of the wall, you could go to Bunnings, buy a tin of paint, and go to town and actually fix it up for probably less than $1,000. Make it fully functional, nice, and hospitable. No problems at all. I'm sick of the argument, Phil. You and I grew up with enough, not enough to say we had heaps, but it's all there available for everyone who wants to dig in a little bit.
So you can buy your first home. So you can be a first home buyer on a average Australian salary quite easily in Sydney.
If
You would need to sacrifice a little bit, but
take on the first home buyer, first home buyer grants, you can get a 5% deposit loan as a home buyer, not as an investor.
Yeah.
Today, if you had an income of, say, circa 60, 70 grand per year, somewhere around about that gross, and you had reasonably tight spending habits and you had saved yourself, let's say $30,000 or $40,000 as a first home buyer, you can buy a property in the vicinity of $300,000 to $400,000 today. That is very possible.
So you could buy that, move in, 5%, no LMI.
No LMI, no stamp duty.
No
you get a
stamp
stamp duty waiver.
You get a stamp duty
you
waiver
get a stamp
as
duty
well.
waiver in certain properties and certain postcodes as well.
Yeah.
And most states have similar policies depending on what you're looking
Live
at.
in
as
it
well.
for 6 months.
And turn it into an investment.
And then
if
it's
you want
investment
to.
property.
That's it. I did it, Phil. When I started out, that's what I did. Surprise, surprise.
Yeah, it's crazy, isn't it?
Nothing was different. I worked,
Would
I
have been
saved money.
Probably the equivalent in sort of money, like income versus
Expenditure.
yeah.
It was there.
And this is the point, right? So if you're a young investor tuning this going, what, really? How much?
And it's not an inferior property. Ultimately, this is the thing that you might then all of a sudden have the argument to say, I'm going to buy it, but it doesn't perform for me. Well, you just explained very clearly you're actually selling a property that you bought a decade ago for half of what you're selling it for today, which a decade ago was an entry-level property.
Yep.
It was as entry-level as it is right now. It's still an entry-level market. It hasn't gentrified to turn into a equivalent of a Balmain or anything like that in the Sydney market.
Yeah.
It's still entry-level.
I saw a photo of it. I haven't been past it by probably 5 years.
You shan't be going in it, I'm assuming. You're going to sell it as is, where is.
So but this property,
But it
right,
does the job.
It's within 700 metres of a train station.
Yep.
It's within 100 metres of a major shopping centre.
Yep.
It's
Schools,
within
hospital, tertiary education.
It's got a hospital within a kilometre. It's got tertiary education
10
within a
kilometres
kilometre.
from a new airport precinct.
Yeah.
This stuff is, and these places exist in every capital city.
Yeah. And that's
Every
now.
capital city. That's today, 2025.
Yeah.
And that's in Sydney. So take yourself out of Sydney. Sydney is still the most expensive city in Australia.
Yeah.
I can point out, if someone contacted me and said, Paul, hey, what could I buy that was similar to what Phil talked about? I could probably point out a dozen different markets that would probably be substantially less than what you're talking about now that will still see relatively similar outcomes in the next 10 years.
Yeah.
We're not trying to shoot the lights out to try and find...
But a lot of people say, but they're units. You don't buy units if you're a property investor.
yeah.
What do you say to that?
I say it depends.
Yeah.
It definitely depends. Look, if you're telling
If that's
me,
all you got and you want to start.
if that's all you got, you want to start. You can wait 4, 5, 6 years and maybe put together double that amount deposit with double the amount to spend. And yes, Luke, you might be able to buy a better property that might perform slightly better. But in that 5 years that you waited, you, in all likelihood, probably missed out on the growth that you would otherwise have got from the
We've
property
probably
that you bought.
refinanced this 3 times, right?
Exactly.
So we refinanced this, bought houses.
That property's probably bought you 4 other properties.
I reckon that property, buying it way back when, probably contributed to buying that one thing. And maybe it's a good experiment to do.
Yeah.
Probably turned refinancing that into $4 million, $5 million
It's
of
amazing, isn't it?
other sort of value somewhere else.
I'll
And
point.
it owes us nothing.
I'll give
Like,
the
absolutely owes
listeners
us nothing.
one property.
Yeah.
Well, I'll give one market. We bought a property in a suburb of Ballarat. It was about 7 weeks ago. It was a 2-bedroom villa in a pack of 6, all single level. Pretty similar to what you're discussing. They had a attached garage with a walk through straight into the house. You had lounge room, dining, living, 2 bedrooms,
Yeah.
single bathroom, separate laundry. Paid $214,000 for a property in this complex. $214,000 7 weeks ago. There was a property in the same complex that was offered to us. We obviously aren't buying it. It was offered to us at $290,000 as of Monday this week. Now, not to say that market's grown that much in that time. We bought it really well at 214 grand. Let's call it the value of that property we bought might have been 250, 260. But the market's already on the move. But these properties still exist. Sub 300 that exists. That's a 2-bedroom villa in a market that's got a multi-diverse economy, no problems. You've got well below replacement value. You cannot build that property for $214,000 if it was a raw block of dirt today. It just can't happen. So you're getting the land for free, ultimately, in that property right now. They exist. They exist across the board. And then back to your point, Phil, how much do you need to get into that if it's your first property or your third or your eighth? You need, in that instance,
so if you're not a first time buyer and getting all these breaks, right? So deposit, stamp duty, maybe LMI if you're at 90, but say you're at 80. What do you need to play?
At 80% on that, let's call it $300,000 after you factor in stamp duty, buyer's agent fee, etc. On that property, you're working backwards. You're probably talking about 60K.
So you got 60K.
60K in equity. You're in on that property without a penny of yours out of your pocket, utilising equity.
We'll talk about that a little bit later on.
Yeah,
I think
that's at 20% LVR.
That's 20% LVR. So it's not a bridge too far.
So 80% LVR. 20%
these numbers don't sound.
They're not onerous. They're not impossible. And
but we're peddled this idea as if it's impossible to buy a property in Australia because it's so expensive.
Yeah. And don't get me wrong, Phil. If you said, "Hey, look, I have way more than that to spend," I'm not going to funnel that same person into 2 properties at $300,000 either, because it is always going to be. I'm a huge believer in less moving parts. I'm not a believer in saying 10, 15, 30 properties in your portfolio and then you've made it. That'll make me rich. It's not going to make you any wealthier than having 5 good properties that are going to do the job of 10. So it's not to say that that's all you should be doing, but it's to say that there is a possibility at that lower end, right through to the middle and higher end.
So comes back to the point, you can't compare your chapter 1 with someone's chapter 6 or 7.
No, exactly.
Or chapter 10. It's crazy. All right. So the point there is that the more affordable markets, the lower 25 percentile, are doing the heavy lifting for capital growth.
Correct.
So if you're chasing capital growth and you're relatively new, or just looking to reorientate your portfolio, and I'm sort of mentally coming back to the idea of playing back in some of those markets, just nowhere else other than in Melbourne.
Yeah, to get some exposure.
But if I was going to do that though, that probably you spoke about, if I could get 5 of them, and it was one sort of completely owned asset, that sort of sounds attractive to me.
Yeah, no, absolutely, and that's where the opportunities
do they exist?
are. Yeah, absolutely, they do. Yeah, those 5 packs buying in one title, they exist. They're fully strataed. They exist as well. Buying 4 or 5 in a row, they exist. I mean, the other big things to also understand is that Victoria changed their granny flat policy about 2 years ago, which also now means that there's opportunities for blocks that have undersupply in that rental side of things, which now also gives people the opportunity to think of buying a house, building an auxiliary dwelling. That didn't exist 2 years ago. There's opportunities there as well. Cash flow can be created very well in the Victorian market if that's the way you want to go, outside of just capital growth as well.
And how are these sort of 300 odd grand townhouses cash flowing at the moment? What's the rents like on them?
You're talking, in some cases, 5.5%, 6% gross yield.
So negatively geared,
but not by a long way.
Yeah. If you're buying property right now, it's very hard to buy and instantly positively get property unless you're putting in big deposit. We're talking about 80%.
Yeah.
Again, a massive misnomer. If you're a property investor in today's market and you're buying at 80%, expect it to be negative geared.
Absolutely. Yeah. And factor in 30, 40 cents in the dollar that you're negative, you'll get back. So don't get too overwhelmed with the cash flow. As long as you can afford it as it is, there will be some upside as well. And there'll be some reprieve from interest rates, and there will also be rental growth. Rental growth is still going to be circa 3 to 5% per annum for the next few years.
Yeah. And that's a good point. And it's again for what's making property news. I saw a piece come out from the Real Estate Buyers Institute. Is it REBA? Real Estate.
No, I'm not a member of REBA, but I do
not
know.
REBA.
The Real Estate Industry Buyers Agency Association.
I should get that right.
Sorry, REBA.
Sorry, REBA. Melinda Jennison.
Yes.
Yeah, is the head of it. She runs a very good buyers agency up in Queensland. They came out and really echoing something I've been talking about for years, and that is, and I like to think, us here at Smart Property Investment, we obviously sort of team up to produce the Pure Property podcast with you. One of the sort of major proponents for using professionals in and around property investment, they put a piece out this week pretty much going, hey, be very, very careful of who you choose as someone to support you on your property investment journey. They specifically spoke about buyer's agents and the fact that there's a proliferation of buyer's agents all out there looking to provide services to Australians. Now, buyer's agents can be a very effective professional as part of your cohort. You can buy property yourself. I buy property myself. I also use buyer's agents, right? I've been in and around a bit for a bit, but I've been quite sort of vocal in supporting the sector moving forward. However, it's at a very it's an inflection point within property investment advisory right now, is that you have a lot of proven, capable, established professional buyer's agents and buyer's agencies. I'd certainly put Pure Property into that mix. But now you've got this sort of groundswell of new people coming into it, trying to provide buyer's agency services to everyone. And their point is going, be very careful who you're using, because there's a lot of part-timers out there who may not have the skills you need in order to be making the right decision. And we're seeing now there seems to be a bit of a sort of scaling up of buyer's agency, commoditising of buyer's agency, and they're more supportive of the growth of the industry moving forward. But, what you should be buying, where you should be buying strategically, whether it's $300,000 properties or elsewhere, you need someone that's pretty experienced to help you with making this decision making. So that's the point we're in right now. There's a lot of noise, and I'm going to telegraph, expect to see 2 to 3 years of discussion around this, as the property investment advisory sector is going to have its coming of age over this next period of time, next 5 years. It will be regulated at a point in time, because when it gets big enough where things start potentially going wrong and you find consumers who aren't happy, they're going to start asking for answers. It will become regulated, and if the industry doesn't sort itself out early enough, and I know this sector's Pippa, for example, has been championed for regulation for years.
For a long time.
It'll be over-regulated and potentially stifle it. So
big stick. I'm
just saying right now to all those investors out there, buyer beware, make sure you're using the right professional that you're satisfied have the capability to help you out with it. And I say this to the property investment industry, just be careful, because
unfortunately, Phil, you've been a champion of this for a long time, but it's not going to change it. And the problem is, and what you're referring to there's some very, very heavy hitters in the finance industry who will be playing in this space sooner than you know it. And for anyone who's listening out there, you'll probably start seeing it hit your feed very soon on your paid advertising. Expect to see some companies that are household names start to say, we are now buyer's agents as well. Did you know?
Yeah.
And for me, the questions shouldn't change whether you're calling up a sole trader or a large company. Is go through your grilling and test them out like you would. Phil, you said to me off air that if you're going to get an elective surgery or an emergency surgery or whatever it is, you certainly don't want to be seeing, who was
a part-time surgeon.
Who was the surgeon in The Simpsons?
Oh, Dr. Nick Riviera.
Dr. Nick Riviera.
How I remember that.
I knew you'd know it.
Yeah.
And that's exactly what it draws my mind to that, is that he essentially comes in and you don't want that person who's a once a month potentially part-timer coming in and thinking, you know what, normally I do this, but you called me up for that option, I'll do that for you at a fee, no problems. Is that what you want? And I can tell you right now, Phil, I've restricted as a company doing things that I know we don't have experience at Pure Property, and there's a multitude of things that we could be doing in-house and vertically integrating. I've resisted intentionally for that reason, because I'm so reluctant to want to push outside of my lane to provide services which I don't have 100% confidence in providing the best outcome, even though there's money to be made, that it simply isn't within our wheelhouse. And I want to be able to utilize experts to do so. So when it starts to be vertically integrated and you feel like you're getting sold the next person in that same business who may not have the experience that you really are paying for, question that.
Yeah, and look, I'm all for innovation in this space. I think it's absolutely critical, right? And I always approach property investment from the view or the minds of the consumer, right? The investor itself. So, the natural evolution of this industry, and call it the property investment industry, buying of properties, is there for the be larger, more scaled, consolidated players. It makes sense, and I think fortunately, some very smart people in and around Australia that hopefully can work this out. But as the consumer, it comes back to the point that you're responsible for making decisions of who you use and how you use them. So you need to have comfort and confidence that the people that you're using to help you make these decisions you need to make are the right people for you. And unfortunately, what's going to happen is that people are going to make the wrong decisions, and they're going to try and look to point blame around it. The blame is an irrelevant machination of this, right? Like just going, oh, well, that's all wrong. That person did the wrong thing by me, or they weren't experienced enough, or they put me in the wrong asset or investment. I'm going to blame them for it. Now, the person to blame is yourself, because you need to make that decision.
Yeah.
You need to be accountable for your decision making. So just ask the cascading questions. Be curious. Ask the questions around whether or not they can do X, Y, Z, well, whatever it is you're looking for. And if you're not confident with it, don't go ahead with it, right? That's it. You're accountable as the investor is the point.
Absolutely, Phil. And I think the big thing that I see doing this for a decade and buying thousands of properties is that the best investors are always the ones who are first and foremost taking full accountability for the outcomes that they get, whether they're wins, losses, or somewhere in between. It's funny, I was actually just on the phone. You probably have seen me. I was on the phone to a client in preparation for this podcast. That was discussing the lease that was on a property that we bought in 2019. That was a commercial asset back then, which is now currently going through lease negotiations with the same tenant to renew. I'm working with this client. I'm not getting paid for it. That was 5-6 years ago now. It was a $1.82 million property in Canberra. That property since had a big special levy that's been imposed on it, which obviously wasn't expected at the time. That happened about 12 months ago. We're going through discussions with the current leasing agent to assess the lease renewal to ensure that these special levies that are being imposed are a continuation on the lease that the tenant pays, because it was in their lease to then pay all outgoings, including statutory charges as well as body corporate charges. Now, they're pushing back saying this wasn't part of it, but obviously this wasn't part of my tenant's intention. I guess where I'm leading to with this is that there is a lot of technicality in that type of purchase. Now, that's not necessarily a common occurrence, but the experience that we have in that space is to make sure we can give advice, speak to the people who need to be speaking to, and make sure that the outcome is going to be there. I can pretty much guarantee that if you're going to be speaking to a new time buyer's agent who may not have bought their first property at some stage in the last few years, are they going to have that breadth and depth of experience to draw on? You're just not going to get it unless you stick with people and companies who have done this and done it over and over. And there's only probably, I'd have to go out on a limb and say less than a dozen of them in Australia.
You reckon?
Of that caliber? Yes. Of that caliber.
Yeah, okay. Yeah, and of course we'll go, well, of course they're going to say that. Yeah, I'm sure you're putting yourself as part of that cohort, right?
But I'm usually pretty reserved in that instance, Phil. I try to play a pretty low profile, but I'll crow when it's time to crow, in the sense that I want to champion not just my business and my company and the people that work within it, but other companies that are similar to ours, because and I'm not suggesting that those companies that fall outside of that dozen are bad operators or are poorly intended operators or bad people. But experience is something that you can't buy.
Yeah.
And that is the reality of property. Property is the ultimate long game investment, and experience is probably the biggest thing that you're paying for in every one of these industries.
And again, you get to choose who you use, because you're paying for it, right?
Exactly.
And here's a hot tip: if it's for free, it's not property investment.
Or if they get paid by someone else, probably not the best advice.
But this is a good discussion, right? Because it means that there's greater emphasis being placed on the need for smart strategic capabilities around investing in property. And if you're investing in property, you're looking for wealth creation, and you want that to be as successful as possible. So just choose the right advisors. And importantly also, and it doesn't really get delineated enough, what you're talking about there, the 10, maybe, Paul, are probably those that focus on property investment. There's a whole other part of being a buyer's agent, and that is buying owner-occupied property, which is a very, very, very different proposition. It's a different skill set, different capabilities, and you have a whole sort of subsector of this market for those people that specialise in owner-occupier. And they're very different briefs, they're very different outcomes, and that in itself, we're fortunate that there's some very good operators out there.
Yeah.
Buyer's agents that do, or property investment advisors that do property investment and those, for the purpose of investment and owner occupier. Some people do both.
Yep.
Some people concentrate on another. You do a bit of owner occupier, but it's not your
It's
thing.
not our sweet spot.
No.
We don't actively want to do it unless it's going to fall within a category that we know we can assist with. That's going to get a better outcome than if someone did it themselves.
So just to conclude on the news side of things, there was a February rate cut. It's about a month or so ago now. We just entered April, where the next iteration of rate announcements took place. There was no increase in the official cash rate. I think the markets are pricing in 2 to 3 more over the next sort of 12 to 18 months.
Yep.
Get it sort of like mid threes.
Yep.
At the official cash rate, which will probably mean that you'll be paying mortgages about 5 and a bit.
Five-ish.
Yeah, 5 and a bit. Which is considerable amount of savings.
That normal, yeah.
That's average, right?
Yeah,
Well,
average.
that's what it'll be when we started investing.
Absolutely.
About 5s,
yeah.
right?
Yep.
Have you seen any changes yet in activity as a result of the Feb rate cut? And as a mechanism for telegraphing what may happen when there's subsequent rate cuts moving forward?
Yeah, and it's important to remember that this data that we talk about here is actually only really taken from most of these transactions happened before the rate cut.
Correct.
So the data that's coming out of this isn't actually necessarily reflective of sentiment and all of a sudden prices changing. April and May will probably show us more of a trend, and I dare say it's probably going to continue on a similar trajectory of 0.3, 0.5, 0.6% monthly average annual growth. The sentiment and I think the ability for people to want to transact is now there. That's probably the biggest thing that changes in these early stages, the first probably 3 to 6 months. People get more confidence, so they're less sitting there thinking, oh, I don't really know if I'm going to be able to see the rates go the way that I'm thinking. The moment it happens, people's mindsets shift and they take action quicker. That's what I notice in these instances. And it hasn't happened for a good 4 or 5 years since we were in the last interest rate cut cycle. And obviously it was a very different proposition back then, although that was the best time in probably the last decade, maybe 2 decades to buy. But I expect that's what's going to happen over the next 12, 18 months. People are going to be less tentative in that moment of, I'm just not sure about what's happening over the next 12 to 24 months with regards to interest rates and cash flow, and can I do it, or is the market going to flatten out or go backwards? The mindset now is I can see that the green shoots are there, the market's growing, money's getting cheaper, rents are still growing, the economy is still pretty stable, unemployment rates are staying about where they have been long term. People aren't seeing massive issues as far as headwinds are concerned. We do have the election coming up. That will probably pause things for the next 6 weeks, which it just typically does. People just sit on the sidelines and wait for the outcome and wait for the washout. From what we've seen, though, in the media, is there anything major, regardless of which party is going to be elected, that is going to be an absolute game changer and is going to be a Donald Trump moment? I don't think so. There's going to be winners and losers, as there always is. But in the balance, the only real big thing that I could probably see, which I don't necessarily expect will get through too far from a Senate perspective, is potentially the population changing policies that the Liberals are looking to bring in as far as limiting annual international migration. That could temper demand. That's probably the only real thing that I look at saying, well, what could affect the market in a bit of a quicker fashion? That's one thing. But again, that has an equal and opposite reaction, right? Like you can't just do that in isolation and think that the market's going to be okay, not the property market, but then the labour market. And then all of a sudden, if you have less people and you have the same amount of jobs, and all of a sudden you're like, well, then people are going to demand to get paid more. And then all of a sudden that affects inflation the wrong way that you're trying to take it.
If you curb migration, and I think, and I saw a graph the other day that like 70% of migration is like, a lot of it, we're not talking temporary migration, we're talking permanent, skilled.
Yeah,
skilled
it's
migration.
70% of all.
And the rest is just like family reunion, all that sort of stuff. So whether or not they just go, they'll just dial down on family reunions and keep skilled, because we need skilled migration, right?
Correct.
But and that's going to have a balancing effect. But where the real balancing effect will take place in terms of whether or not it's going to have a consequence on demand in New South Wales, right now the 5-year target is to build 329,000 new dwellings in 5 years, right?
Yep.
That's 56,800 each.
Which we're not doing.
Each year. That's 16,450 a quarter, right? So New South Wales need to be building 16,000 new dwellings a quarter.
4,000 a month.
Yep.
Settled.
Yep.
Keys in hand.
The results, the last print of info We did 11,220 in the September quarter. So we were off by 32%. So it's 32% in order to sustain what is a distressed housing economy now. If you dial back immigration by whatever it is, it's not going to change the numbers that we're still not building at the speed we need to be building.
I know, it's definitely not going to change.
There'll be a long-term catch-up in time,
Yeah.
but we're 30% off target right now on what we need to be building, right?
Those targets are always ludicrous. And, but I mean, extrapolate that across every market. They're all about the same as far as the percentages are concerned. That's not going to change. And I guess
VIX 15% negative, Queensland 40% negative, South Australia positive 32%.
There you go. That probably leaves a little bit of a clue for most who want to look at that.
So they are built, and maybe they just
surplus.
got a whole bunch of new developments online. So they've got surplus there.
Yep.
Even though now South Australia is
growing.
growth,
It's growing at 15% per annum.
WA was off by 26%.
Yep.
Tassie was 135% over.
Yep.
Right, they had to do 300. They did 704.
Yeah.
But 704
it's
versus 11,220.
It's a very big difference. And this is why you got to only really look at your big four, big five cities to really get any proper correlation there. But I guess the reason why I brought that up is that you got to think of like what policies can government implement that is going to affect a market quicker. Yes, look, we're in deficit as far as what we're building, but that's based on the current level of demand as well. If you bring down demand, then these growth numbers that we're looking at, that they do get affected. So I'll be looking at that personally, but again, that's not going to impact anything in the first few weeks, months, potentially even years, even if it did get through. But I think typically these things get watered down dramatically because there's a balance of where the skill shortages are. We're at a skill shortage. We typically have been for an indefinite period of time in this country, and I don't see that changing across most sectors.
Do you ever read on the Coalition come out maybe yesterday or the day before, I can't remember, pretty much arguing for changing the buffer serviceability?
That was a big one, and that was what I was going to refer to as well, is that's the other side of the equation, is that, yes, although this immigration policy might be tinkered with, there is discussion about changing where the APRA essentially buffer is now implemented at 3% above whatever cash rate is of the day. And they may temper it to say it's only to owner-occupiers or whatever it might be, but either way, it's going to increase demand. And they're very right in saying it, that this was increased during the heights of COVID because rates got to emergency lows, and you can't just service people on basically paying 2% interest on their loan. We had to throw in an extra 3% to take it up to, hey, can you afford to service a 5% loan, which lo and behold is where we basically will end up being. But at the moment, when we're paying 5 or 6%, you're being serviced on 8 or 9% in most cases. Is that realistic? Are we going to be at 8 or 9% the next 5 odd years? Highly, highly unlikely.
No.
So
but they can always put it back in, and
correct.
You look at the how these things can play out together. You look at these in isolation. That makes sense, right? So, you might get the official cash rate in the 3s, so therefore you're paying sort of 5s. If you get interest reductions coming down another 75 basis points. And then say the buffer goes to 2% rather than 3%. That's
1% equals 10%.
That's 1.75% potential change immediately in serviceability. That's going to change.
Well, this is it, Phil.
That's going to change the needle.
And it's funny you brought that up. I remember a conversation I had with Steve Waters about 2 years ago. Maybe actually, sorry, I take that back. It was about 4 years ago. I was driving home from this place here, from this office after doing a podcast, and he gave me a call and we were talking about something else. And Steve was a very insightful guy, but this was during the time where rates were going down dramatically, and we always used to chinwag a bit to say, what's going on, how are you seeing things, etc. And I just remember it clear as day when you said that. He said, Paul, I've seen it only once or twice before. The last time was really GFC. He's like, when things got like this and we saw rates come down and we saw essentially our economy was still very strong. We had all this demand, but money just got so cheap so quickly. It is going to be boom time. And this was before the 2020 boom. This was after COVID was announced. Lockdowns were there. Everyone was in panic chaos. Same time. So it was 5 years ago now. It was essentially we're in like March, April when it was absolute peak chaos. Yeah. And I shared the same thoughts with him. I said, I know, mate, we're working our best to try and keep people on board because they obviously are freaking out, but I can't see how this doesn't play out in a massive positive. And to your point, Phil, if we see that APRA rates, even the buffer drops by 1% and we get another 0.75% drop in
it's 1.75%
and for everyone to know out there, every 1% in interest rate movement equates to about 10% more borrowing capacity. So if you get 1.75%, we'll call it 2%, that's 20% more borrowing capacity. That typically goes straight into the market.
Yeah.
So people can borrow 20% more, they pay 20% more.
And you put this in a perspective
and
also.
you've got a deficit of property.
Yeah.
So you don't have the choice. So people aren't going to go and soak up all this extra stuff that's sitting on the market. It's not there to buy in the first place. We're not building it.
And if you want to sort of layer in another element of that, if we are to get a change in government, one of the coalition policies is to allow first-home buyers to tap into their superannuation.
No, that makes me nervous. To a degree. There's validity in it too.
So you think about it. You're tapping your superannuation.
I know. You got instant deposit.
5% deposit, no stamp duty.
Yep.
No LMI.
And you can borrow more.
Yeah.
So
and your service bill is increased by 20%, 1% off the buffer, 75 basis points down. Like,
yeah.
You put that in a perspective.
Dots, people.
Yeah,
connect the dots.
Connect the dots. So what do you do? Okay, so we've rabbited it on for 50 minutes about stuff that's probably largely irrelevant. Okay,
Speak for yourself.
No. Hang on. Listen to this.
Bring it all back.
Back to my original point. The process will determine the outcome. Concentrating on those things that you can control, don't worry about those things you can't control, right? So let's use those two. And the other point also says you've got to have a bit of fun with it, right?
Yeah.
But anyway, but on the second point, concentrate on those things you can control. So largely what we're spoken about is inverted commas noise, right?
Yep.
It's a lot of what ifs, what's it really matter? What's it really matter? What can you actually do about it? This is the second one. What do you do about all this right now? And what would you be doing? What are you recommending people doing right now, considering this picture that we've painted, which seems uncertain, who knows, where's it going to go, whatever. But I think the underlying position you would make is that there is opportunities in certain markets. And if you've got a bit of gumption, you've got your finances sorted out, how do you get in? What do you do? Something really tactical.
I'll share something with you this morning, Phil. I got off the phone with a wealthy client who has...
What do you classify as wealthy?
Probably net worth about 30, 40 million.
Okay, so like, very wealthy.
Yeah, wealthy. Yeah, wealthy. Yeah. And long-term earner, good job, invested regularly in property majority for a good 25 years. We've probably bought them 8 or 9 properties over the last 5 years. They've got other properties they've bought, and they came out of a meeting this morning and they said, I'm ready to gear up. And that conversation, they're different than saying how much equity do I have, how much can I borrow. It was, I'm ready to gear up. What does that mean? My conversation went straight from there saying, can you give me half an hour? Because I know their numbers. They're also clients of Finney's. And I went to the head broker at Finney, Eva, and I basically went straight from that conversation straight into a meeting with her and said, look, I spoke with Joe Bloggs and our conversation is he's ready to go and push to put a bunch more property in trusts over the next 6 to 9 months, in particular in the Victorian market. He was light on. He wants to get going there, get exposure in the vicinity of wanting to get, say, 5 to 7 million exposed as quick as possible.
In debt or
in debt? In debt. So wants to get that debt out. So the conversation that you can bring that right down to saying I have one property and I have $70,000 in equity that's available in it. It's exactly the same conversation. For me, that conversation, I took the control of it because I didn't want him to be burdened with it. I had all his numbers. So what's happening right now is we're going through the valuation and getting that equity out and going through the paperwork that's needed. Actioning that is the very first step. So the key is if you've got an asset, and let's just assume that you're a person who's got a property or potentially a few properties and you know that there's some sort of equity in there, do you need a lot? Well, it depends. We went through an exercise only 20 minutes ago that walked through properties that probably only need, say, circa $55,000, $65,000 in total equity to cover deposits, closing costs, stamp duty, etc. That's probably your starting point, right through to 5 to 7 million as that example I spoke to this morning. The conversation needs to figure out what do we want to buy, how does that fit in, which markets, which that's our job to give that information, then get that finance ready to do it in the way that's possible and then get exposure. Because as we've just alluded to, when you start to think about what's happening and what's happening from a general groundswell right now, it's all happening in the sense that it's moving in the direction that is showing positive growth. So you need to get equity out before everyone is thinking the same thing. And then get it into market.
Get it in the market. And what sort of stuff would this person be buying? They wouldn't be buying this sort of 300.
They're not buying that. So they're going to be buying a mix of probably the budget wise, they're going to be somewhere between 600 and about 850. And they're buying 3 and 4 bedroom 600 to 900 square
Close
metre
to the
blocks.
town.
There's a couple that we're going to be looking at that are just straight up 10-year-old set and forget brick and tile in probably middle ring markets that are going to be just genuine, no fuss 10-year plays. And then there's going to be a couple that we're going to look at as buy and hold, still with only really a 2 to 3 year horizon as a minimum, are looking to buy on a larger block with a potential upside for subdivision, or potentially there's a couple that we might look at for sort of quarter acre blocks in larger, sort of more higher development opportunity areas that are going to be more negatively geared. Still can't afford to go super negative in cash flow. As much as I said their net worth circa 35 million, they're still not necessarily wanting to see a massive negative gearing because these are in trust, these purchases for them, and they're also looking at it to be perpetual, so they don't want them to be burdened with a massive negative gearing because they actually do want to give them on to the next generation. So they're not just thinking about them in their own cash flows, they're thinking if I slide this over to my son or my daughter, is this going to be a burden for them? And they're not just thinking about their own situation, which is important, and it's good counsel, because I think just because they can afford to hold multiple properties highly negatively geared, does that still make sense for their overall strategy? And that's part of what we've worked on in that long-term strategy with them as well.
All right, so that's probably a different end of the getting into $250,000, $300,000 properties.
Slightly different.
So you're happy to work across the whole?
Oh, absolutely. We work with those high net worth individuals right through to the person who's got their own home, a little bit of equity, want to get moving. I mean, literally after that conversation, we went to another conversation with a client who bought 2 properties in Perth in 2022. They now got enough money via a collective bargaining agreement, which saw only literally as of, I think it might have been last week, that they got a back pay from July on a 4% pay increase, which meant that their super goes up because they've got an SMSF that they've already set up, and they all of a sudden now realise that they can borrow about 500, where previous it was only about 220, because they can now inject a whole bunch more money, and there's a bit of back pay that goes in their super. That's all of a sudden leading to now another property in their SMSF, which was a separate conversation I had this morning as well. They happen. There is opportunity in every way. Where that conversation led to them wanting to do something, though, is that their broker is Rebecca at Finney. I know for firsthand that Rebecca's outstanding, but she probed different angles with different SMSF lenders to look at how they're going to treat.
Rebecca does my loans.
Oh, does she? Well, you haven't really given
Don't make her too busy.
Well, she's obviously doing. She's moonlighting with one of my clients there, Philip. But I guess
the priority.
My advice there, though, is that dig into your broker and ask them to get busy, because if they're not doing this stuff proactively right now as far as refinancing and looking at where the opportunities are, banks are hungry, the equity's there, growth has been in the property as we've shown with the data. There is going to be cheaper rates on the horizon. Your serviceability has probably increased a little bit over the last few months. It is buying season. So don't take no for an answer. If you do get a no, find another broker who's potentially going to dig a bit deeper and find different opportunities. There's typically always money to access. It's just at what cost.
Okay. We've solved everything.
Not quite.
I just sit there going,
how did we get to this point?
how do we get it? I just get annoyed with my lack of activity in property again as well.
We're going to action the Fast 50 this year, Phil. We talked about the last 2 years. You said you were going to action something.
You know what?
Action something. You're going to action something. You
had
never actioned it.
You know
cost
what?
you money.
No. Yes.
Oh, you heard it here first, folks.
I will this time.
All right. You're going to you need to put a time constraint on when you're going to action it, because I know how you operate.
Yeah. Yes
could mean yes in 3 years.
No. Yes. How quickly are you going to action on it?
But you give me the chance and I'm actioning.
What are you going to do? We're going to go in the same location?
Well, it depends on what we're going to do. Like where and what and how. It's not going to.
I'm not going to use you. I'm not going to use my buyer's agent.
Well, you don't need to use
Melbourne.
Melbourne.
Someone else.
Oh, well, I can give you some reputable names. You can ruin their day.
I want a part-timer.
You can ruin their day.
I might try. I might do it myself.
Speaking of Steve, rest his soul. It was a funny thing we always used to do to each other, is basically pass on numbers of people that we just didn't want to work with.
Oh, really? Well, you just go.
I've got a number for you. Call this guy.
God.
You can call that guy, whoever that guy might be. Yeah. You can give me a call and I'll pass on some numbers.
That's all right, mate. Do you know how many people out there would want to be my buyer's agent?
Please. I tell you, if they wanted to be your buyer's agent, they don't know you well enough and they're thinking that there's going to be a different outcome than there actually is.
Yeah, well, I'm working with a real estate agent right now just to try and sell some stuff, and that's a very
They're
good
already
agent.
looking
by
at
the way.
new vocations, no doubt.
People think it's a good idea to do my stuff, and then they soon realise that
It's not.
It's a nightmare.
It's very bad.
It's a nightmare. It's a nightmare. But how do you track you down? What's the best way?
Mate, they can track us, and I'll tell you this, we're going to hear a lot from us over the next few weeks and months, but purepropertyinvesting.com. We've got our new office in Cronulla. We're moving in as we speak. Beautiful. Got a new space for us to catch up.
Can people pop in and say good day and you buy a coffee?
There is a by appointment only on the front door.
It is no
locked.
hawkers?
No hawkers.
Or solicitation?
However, there is a phone number, so if you do want to get in contact with us, you can go on the front there, or you can just give us a call, 1300 98 5428 if you want to lock in a time. One thing I will, and I'll give a little, it's not going to be a full spoiler alert, but there will be some news coming to Pure Property very soon where we've been working on something which has probably taken me off and on 6 or 7 years, where we have devised and are just about to finalise a full property investment planning map system, which is going to allow anyone, both our clients or externals, who want to really know how to map both their current existing assets, future aspirations, and everything to do with a very detailed plan. We are about to launch it as a service within our business. So if you're sitting there and you think, I've got one property and I've got my home and I want to retire in 16 years and I need this income, we have now devised a tool which is going to be giving people not necessarily the what properties to buy, but this is going to give you the accuracy to say, here's what you need to do. And it is about a 15 page essentially spreadsheet, which is going to be devised into a 1-page plan, which is automated, data-driven, and is going to be a game changer for anyone out there who wants to actually know where they are and where they're going to get to. So watch this space. We're going to be launching that as a service for anyone out there who's going to be interested within the next probably 6 to 8 weeks.
There you go. A machine.
A machine.
You need a machine.
That's
you need
me.
A machine. You need it. Well, thanks for coming in, Paul. Good to see you. The Pure Property Podcast with Paul Glossop. Go and track these guys down. They're all over the social media as well. You can find them and like them and follow them and do all that good
Give us a
stuff.
rating on this podcast too, by the way.
Yeah. 5
review.
stars.
Doesn't have to be 5-star, but just any kind of
4.5
review.
stars.
4.5 stars.
4.5 for me, half for you.
Yeah, exactly. I don't need any, but just a rating, just to give us some feedback would be always handy. So jump on to whatever feedback you can provide on your...
Yeah, on the Apple or the Spotify. Yeah, we like that. It's good. It's nice.
It is actually very handy for us.
It is handy.
I do read them, and I like to use them to give more, I guess, pointed a service as far as what kind of content we're putting out there.
I was looking at the top podcast for March on the Property Investment Podcast Network where people tune into this, and there's top 3.
Top 3?
Yeah, it was number 2 actually.
Number 2.
One of the other podcasts I did was better.
Oh, really?
No, one of mine. No,
gotcha.
No,
just one of yours.
No, out of the whole.
So you own the whole ecosystem.
The Smart Property Investment Show was number one episode on that was number 1.
Right.
And then the Pure Property Podcast was number 2.
Well, we need to get it to number 1,
episode.
people. I'm not happy with number 2. I've never been satisfied.
Yeah, winners and grinners. Either way, I win no matter what.
Always.
Always, because I'm involved. But thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.